Hi, I'm Tyra Banks, and today we're going to discuss annuities. So it's definitely my pleasure to offer these videos to you. If you guys have topics that you need clarity on when it comes to studying for your life insurance exam, please definitely reach out. I do get to the comments sometimes just a bit late. So I am not health licensed. I am life licensed and I'm investment licensed. And so if you are taking the life and health test, these videos can help you on the life side. They will not help you on the health side. Also, if you need to purchase a copy of my notes, you can visit thepurposefilledwoman.com. All right, let's dive on in. So one thing I want you to memorize about annuities is that life insurance is not annuities. Life insurance creates an immediate estate, and annuities liquidate an estate. Life insurance creates an immediate estate. So when you purchase life insurance, if you pass away, you're immediately worth this lump. Annuities are different. And so, it's tough for me. I had to remind myself all the time, annuities are not life insurance. Brain off life insurance. Every time I would study annuities, I would say brain off life insurance because annuities are not life insurance. Annuities liquidate an estate. So I want you to picture piling up a bunch of money. Maybe you won the lottery and you have this pile of money that you need to turn into payments. So annuities would take this chunk of money and then turn it into payments that you can't outlive, right? So that's generally the purpose of annuities. One of the number one vehicles for retirement. So there are different parties to an annuity contract. The annuitant, that's the person who's receiving the benefit payment. That person must be a natural person. The annuitant must be a natural person. The owner of the annuity can be a corporation, it could be another person, but the annuitant must be a natural person. All right. So when you break the name apart of an annuity, whenever you're studying your information, and I want to encourage you guys, don't just take a bunch of practice tests and think that you can go pass this test. The life insurance exam is very difficult. And so even though people pass that way, they really don't have a true understanding of the concepts. And so it's one of the more difficult ways to pass. A better way to pass is to get a hold of a manual, right? So going through an organization like You Can Pass or one of the other ones, I'm not trying to endorse any training program, but you want to go through some type of training program where you actually get a manual. And that way you can break the concepts down. And so I want to encourage you guys to do that. When you're studying annuities, if you look at the name of the annuity, it will help you recognize what type of annuity it is. Okay. And so that's just another kind of testing tip as we dive in and kind of go through the information on annuities. So here are my notes on annuities. Usually annuities are providing an income for a person that they cannot outlive. But annuities can be used for college education. They can be used to liquidate a lump sum. Annuities do not pay a face amount when the person dies. So they're not like life insurance. With life insurance, you're buying a $100,000 policy. With an annuity, you're taking a lump of money and then turning it into payments. The beneficiary. So you got the owner of the annuity. That can be a person or corporation. They have all the rights and they get to pick a beneficiary. The beneficiary is the person who will get annuity money if the annuitant dies without having liquidated the annuity. So if there's still money there based on the type of annuity that's created, a beneficiary would receive the rest of the money. All right, so we know we got an owner, we got an annuitant, and we have a beneficiary. Now let's talk about how money gets into an annuity. That's called the accumulation period. And so that buildup of money is called accumulation. And when money starts to get paid out of the annuity, that is called annuitization or the annuity period. So the accumulation period, that's also another way to think about it, is the pay-in period. You want to think about how did money get paid in to the annuity. And so it can be paid in different ways. There could be a flexible premium where you're putting in a different amount, or you could put it in all at once. You can put in a lump sum premium. When the annuity money goes in and the annuitant is then looking for the option of how to get it out, right? when they're thinking about the liquidation options, they're going to look at a couple things about their own life to determine what's the best course of action for them. The size of the check is often a major factor for people when they're thinking about taking their annuity payments. And there are a couple things that are going to influence the size of that check. Where you have the age of the person. So the older you are, the bigger your check is, because you're closer to death statistically. The older you are, the bigger your check is. Also, your gender matters. Women live longer lives than men, so on average, women's payments are going to be a little bit smaller than men, because the company realizes we've got to pay a woman a lot longer because women live longer than men statistically. The frequency of payment, and so how often you need to get a payment, that impacts your money. The interest rate at which it's growing, and the total amount of premium paid, or the amount of cash value that's been accumulated. So how much money is actually in the pot, that's going to determine how much your payments are too. And so one key to remember is that the oldest man gets the largest check. The oldest man gets the largest check. So the longer the life, the smaller the check. The longer the life, the smaller the check. There's one way to remember it. Or the oldest man gets the biggest check. Okay. If an annuitant dies during the accumulation period, so while that money is being built up, if the annuitant dies, then the insurer, or the company that's issuing the annuity, usually an insurance company, they are obligated to give the money to the beneficiary. So the accumulation period, remember, that's when you're putting money in. So you have not started taking payments out during that time. The accumulation period is when you're putting the money into the annuity. All right. So another note on accumulation is that pay-in period could be periodic payments where you're paying every month, every couple months you're putting money in. It could be all in one lump sum. It doesn't matter. It could be what they call level, which is the same amount that you're paying over time, or it could be flexible where you're putting in different dollar amounts over time, or it could be all put in at one time, lump sum. So hopefully those different examples help you understand what that means. All right. And so how you get the money out of the annuity is another thing that we're going to go over. You can get it out immediately. That's when you start taking payments out within the first year of you putting them in. Or you can take them out in a deferred way, where you're waiting over a year to start taking those payments out. This is another note about quick thing about suitability. So an annuity is not a suitable investment for every person, because some people, they have immediate cash flow needs and they cannot wait. They can't have their money locked up and then wait to withdraw it out. Non-forfeiture is another concept about annuities. So annuities have a guaranteed non-forfeiture value. If money is in an annuity and you have not taken it out, there's a guaranteed amount of money that should come out of there, right? Because you haven't started the annuitization process. And so that money, that surrender value, is called non-forfeiture money, non-forfeiture value. And it's available to the owner of the annuity. Now, when a company takes the annuity money from you and they invest it, they're banking on having it with them for a certain amount of time. That's how they estimate the interest that they're going to receive. And so if you want to come back and take it from them early, then they charge you, right? And that charge is called the surrender charge. So that fee helps to compensate them the money that they lose if you take your annuity out early. At surrender, the owner of the annuity gets the premium paid, that's the money they put in, plus the interest. So whatever that money grew, they get that. There's a caveat though. So let's say you have an annuity and you want to take your money out of it, but it's not time yet, right? You're going to surrender that annuity. That means you give up your contract with the company and you can get access to the money. You're guaranteed to be able to get your cash value plus the interest that's accrued minus. So that means there's some money that gets taken out. The surrender charge is the money that is subtracted from the annuity. So it's almost like an early termination fee on your phone contract. Right. And that usually goes down over time. So over time that you have your contract in place, you're going to pay less and less of a surrender charge to get out of the contract. Sometimes those fees can be waived. So if you go into a nursing facility, permanently disabled and that kind of thing, you can have that fee waived. So if you are in a long-term care facility for 30 days or more, you can have that fee waived. All right, the bailout provision. So you remember, some of you guys might not be old enough to remember this, but in 2008, the market crashed. So our stock market crashed. Our economy took some serious hits and issues. During that time, interest rates fell. And so if a person had an annuity during that time and the market went down so far that it was not advantageous for them to keep their annuity, the company would allow them to bail out of that contract. And that's called the bailout provision. Okay, so that's on some annuities. And it is a provision that allows the contract holder, which is the owner, to bail out of the contract. Here's how I want you to think about annuities, and this might help with this concept. When you enter into an annuity, you sign a contract telling the insurance company, hey, sell me a guarantee that you will keep this money safe and together. Safe relative, right? I'm not saying it's a safe investment. What I'm saying is that you sign your money over to the company and they guarantee you a contract that they will continue to send you payments from this money. And so when you sign it over to them, you're signing it over to them with a certain understanding. You know, the understanding is based on you're not going to go take the money out, and they're going to make sure that money is there for you to get your annuity payments. All right, so that's the contract that y'all enter into. Now, there are different options on how the money gets invested. So if you create an annuity, you can create an annuity with different investment options. So first one that a lot of people look at is fixed annuity. A fixed annuity means that you're going to have a fixed payment that comes. Your payments are going to look the same over time. You're going to have a fixed interest rate. So that's fixed annuities. Now there's a guaranteed minimum interest rate. So that's what I mean by fixed. And that the payments don't change. And the downside to this is that you're going to lose purchasing power going with these. So again, this is not a judgment to say whether this is good or bad. This is not at all a solicitation to get an annuity or a bash to not get an annuity. I'm just helping you understand the concept for the test. The downside to the client when they're looking at a fixed annuity is that they may lose purchasing power over time because of inflation. And so they will want to be aware of that. All right. Because the fixed annuity money, it's called assets, they're not being gambled with, right? Or they're not being invested anywhere. And so the company can keep that money in their general account with their general assets. And then there are interest rate guarantees. So the company may say, oh, we'll guarantee you a minimum interest rate so that if interest rates drop, they'll never drop below this guarantee. Equity indexed annuities. So these are fixed annuities also. So even though you hear equity there, don't get confused. Equity indexed annuities are fixed annuities. They invest in more aggressive set of investments that they invest in, so they're not as low interest as your traditional fixed annuity. But with a equity indexed annuity, the current rate can actually be more than that guarantee, and so your account is credited that current rate if it happens to be more than the guaranteed rate. Usually these are tied to a familiar index that we all have heard of, usually something like the S&P 500. And now we talked about the fixed annuities. Let's talk about variable annuities. So variable, think about the word varies, right? So can change, can be different. With variable annuities, they're more risky. So there's the potential for higher reward there, but there's definitely higher risk. The money goes into the company's separate account. So with variable annuities, the money is going into the company's separate account is what they call it. Now, variable annuities are one of those products that you need to have an insurance license and an investment license to sell. You have to have both. And you're regulated as the individual selling it. You'll be regulated by FINRA, FINA. That's the Financial Industry Regulatory Authority, FINRA. And the product is regulated by the S as in Sam, E as in Eagle, C as in Cat. The SEC, the Securities Exchange Commission. Right. With variable annuities, there is no guarantee of a minimum interest rate all the time. All right, let's talk about, we talked about it's not guaranteed an interest rate. Let's talk about the licensing requirements. All right, so you have to have a valid investment license in order to sell these. So you have to have that securities license, and you must be licensed in your state with your life insurance license. So we've talked about how the money goes into the annuity. Let's dig a little bit deeper on how money comes out. So the benefit payments, these are called the annuity benefit payments. All that means is how's the money going to come out of my annuity. And there are different ways that can be structured. And so one of the most popular is called life contingency. So anywhere on the test, if you see something that says life annuity, that means the person will get a payment for their life. So the rest of their life, they're getting a payment if it's a life annuity. Life with period certain is one kind of payout. That's where a certain period of time, you are guaranteed money to come out. So it means even if you died younger than expected, there would still be that time guaranteed where payments should come. And then you have life with period certain, right? So that's where, and I'm so sleepy, y'all, because I've been up with my little baby. So I apologize if I look tired or high. I promise you I'm just tired. So with life with period certain, that means the person is guaranteed a check for life, but if they died young, there's a certain number of years that money is guaranteed. So the beneficiary would receive the rest of the years. So let's say I had an annuity life with period certain of 5 years, and I died at year 3. There are 2 years left that my beneficiary would receive those benefits. Annuities can cover one life or multiple lives. So you don't have to just cover one person. And so with a life annuity, the payments are made with reference to one life only. Okay, now we have joint life. Joint life just means first to die. That's the easiest way to remember it, right? So with joint life, it's an annuity on more than one person's life, but the payments stop when the first person dies. Now, this is very important as to why we have to get educated about finances and be out in our community. Even if you don't do insurance on a high level, every day is your full-time job, I want to encourage you to become very knowledgeable, because you can help people with everyday things like that. You know, making sure that a couple, let's say a couple is getting prepared for retirement and they're picking an annuity. But they really have to be cognizant of what would be the effect if they picked a life-only annuity and there was no check coming to the family when the spouse died. All right. And then you have joint life, and then you have joint and survivor. This is where there's a check coming for both people up until one dies, and then it drops down. And so it'll be joint and half survivor or joint and 2/3 survivor. All that means is there's a check that's coming for both people while they both are alive. And then if one of them dies, the check going to the second person drops down by half or drops down by 2/3. personal uses of life insurance. So a lot of times people use life insurance for retirement, but life insurance can be used for other things too. And so that's why it's very important that we understand what's be most suitable for our clients, and that we're only recommending things to them that actually fit in their lifestyle. We're not getting them to live outside their means. Alrighty. So there are annuities that have like a certain aspect to them that are guaranteed, and these are called annuities certain. So they may not be life annuities. Remember, we talked about earlier life with period certain. That's a life annuity. That means this person can get a check for the rest of their life. Now we're going to talk about annuities certain. That's where the person who's receiving the benefit payment is only guaranteed a certain amount of time, for example. So that is a fixed period annuity. And then there's fixed amount. That's another annuity certain, where there's fixed amount of each check that's coming. So that payment is going to be the same amount every time. Right. So some people use annuities for long-term care, lump sum settlements. And what I mean by using it for long-term care, that means, let's say you had an annuity and you needed to go into a long-term care facility to be cared for, that you could use your annuity money, unlock that annuity, and use it to pay for the long-term care facility. Also, funds for lump sum settlements, and so taking money that maybe you won the lottery or got a big lawsuit, that money could be put into the annuity. So that's another option. All right, so if y'all have any questions, you can definitely always email me, thepurposefilledwoman@gmail.com. Visit thepurposefilledwoman.com if you want to check out my shop, and I wish you all the best.